Today I want to take a look at Party City. Party City launched its IPO on April 15th at $17 per share, and now it's trading at $21.25 per share. So where's their stock going to go from here? Well, what's interesting about Party City is they do have solid financials. When you compare this with some IPOs that have happened in the past, such as Facebook, Facebook's financials weren't quite solid or robust yet, and their IPO stock price fluctuated. It shot up tremendously after their IPO, then reset, and now it's back at a pretty high level. Well, when you look at Party City, their revenue, which was $2.27 billion as of 2014, had shown an 11% growth over 2013, and their adjusted EBITDA was $326 million. Now, when you take a look at the cash flows of the business, and if you believe in discounting the cash flows as a measure of value of the business and stock value, it actually seems like their current value of $21.25 is at the low end of the expected range. This is again assuming that their 11% growth will continue. Now, what's nice to know about this is there's a lot of unknowns about their financials until they actually come out with fully produced, full year financials, right? The financials that I'm looking at right now is just from their prospectus. And it is often in IPOs that these financials might get adjusted. So barring any major adjustments, it does look like the stock could potentially increase. So these are the opportunities we like to look for as investors. We like to look for opportunities where the cash being produced by the business shows a value that is higher than what the company is currently trading at. And if that's the case, then the stock should go up. Now again, there might be other situations aside from the discounted cash flow analysis that might render the stock price to decrease further or even increase further. These are headline situations, or most importantly, some sort of unexpected earnings announcement that might show their growth not to resemble the trend that we're looking at now. The only other thing to note is their prospectus did not show a full cash flow statement. We made adjustments and we made estimations based on averages of companies in this industry to estimate what their cash flow could be. So there could be other things in their cash flow that would bring their cash flow down, reduce their expected cash flow analysis, and would reduce the stock price. But even if we conservatively assumed negative, the most conservative of averages, meaning that their cash flow would be lower than what they're projecting, even in those situations, it looks like their $21.25 stock estimation is at the low end of the average range. So if we run the case where we assume that everything's going to continue as noted in their prospectus, they're going to continue with their same growth as they estimated in their prospectus, it looks like their stock price could be valued around upwards of $33. The only other thing, if you really know about the cash flow and if you know about the way that we in a discounted cash flow analysis, you project out cash flows and discount it back to present value. The only other thing that is a bit of a mystery is the beta that goes into the weighted average cost of capital analysis, or the discount rate of the cost of equity. That was a mystery since the stock has only been trading for a little over a month, or just over a month. So even in that situation, if we run an average of betas, a more volatile beta and a less volatile beta, it still looks like the $21.25 share price is at the low end of the range. So again, these are great opportunities that investors would look for. There is a little bit of mystery in how robust their financials are in this case, but I would definitely watch this stock and am excited to see what's going to happen next week. Thank you for watching Trading on Technicals. If you have any questions, you can find me at the New York School of Finance.